Hello, welcome back. A well-known stock, Draftkings, seems to be crashing right now, and it has been rewarded with massive hype and a lot of steep increase really over the last couple of years or so. As you can see, it used to be around 10, and then it went as high as 75 over here, and now it's actually really crashing, and it has come down to 17, almost $17 right now, down 22% right now on the latest earnings report, which investors didn't really like because the company reported wider than expected losses for 2022. All right, so we're going to be taking a look at the financials of the company and see whether it's a potentially interesting buy. And this stock and this company specifically is one of the prime reasons and one of the prime examples that you can use for making a case about buying value instead of buying into hype. And you will see what I mean as we go through the financials of the company. First things first, the shares outstanding here, outstanding shares, were increasing as expected just because the company was issuing more and more shares taking advantage of the higher stock price. And so it was massively diluting investors. And it looks like they have stopped sort of like recently, I guess just because the stock price was going down. And massive short interest, increasing more than 10% right now. So people look to be shorting the stock potentially. Maybe this could cause a stock squeeze later if this becomes too high. Now, you will see that this is down almost like 70% right now, and it has really crashed to the ground. And we will still see the financials and actually discover why that is the case. You will see here the annual income statement. The company's revenues are increasing, but revenues are not the end all be all, because you could be making a lot of money but not really making any profit. Because if you sell anything really, but you don't make any money, any net income from this sale, I mean, what's the point of the sale and what's the point of operating? Of course, you could make a case for a company growing and eventually making profit, and that makes sense. But at some point, investors do want to see the company turning into profitability. And is this the case with DraftKings? Let's take a look. The net income of the company, you will see, they used to lose in 2017 $75 million, and now they're actually losing 1.4 billion. So they are really increasing their losses here, which is really underwhelming to see. And as an investor, I would be sweating bullets right now if this was happening, and especially if I bought at a very high level. And you will notice here the company's total liabilities are sitting at $2.4 billion, while the total equity is sitting at $1.8 billion. So they have more debt than equity. And this is a very dangerous situation to be in, especially when you're not making money. And you will see here in the cash flow statement that the cash from operations is negative again, I mean, as expected. Negative net income, negative operations cash. And so the company seems to be really lacking in terms of making money and keeping money. So the cash from investing, the company is still, investing a little bit here and there with as much money as they can use, I guess. And the cash from financing, look at that, a lot of positive here values, which is bad because the company is actually issuing more shares, a lot more shares, 2.5 billion and 1.1 billion, plus getting debt, 1.2 billion. So that's not good. And look at the free cash flow, minus 89, minus 59, minus 95, minus 349, and minus 472. So it makes a lot of sense that the street at some point wants to see the company making money, right? I mean, the company is losing free cash flow every year and losing more and more, so increasing its losses here. And the multiples, yeah, they're relatively okay, but it doesn't really matter here because the profitability is horrible. And the total debt to equity, as expected, is growing higher and higher over here, although it used to be even higher, but I guess they made money by selling stock to investors. I mean, investors were looking at the price, it was going higher and higher, and so at some point they were buying more, and then they went down, and then they were buying more. The problem is that if you really know what you are doing, if you're a value investor, you wouldn't be entering this company because there's nothing to there's no value here that you could actually buy. It's very speculative, and I mean, the company is not making money, has a lot of debt, is issuing shares, and it has lost 70% of its value. Now, people will say that the company has lost a lot of its value, thus it's gonna gain its value back again later. But that's not how it works. It could continue with hype. I mean, eventually, if the stock market kind of reverses course again and we go back into the hype days. But it doesn't make sense in terms of what the company is doing financially. And so when that happens, then it becomes way riskier to actually expect this kind of steep increase to happen over the years. And if a company goes down 50% and you lose 50% of your investment, you actually need to make 100% to regain, to actually go back to your previous levels. Because if you own a stock that's worth $10 today and loses 50% tomorrow, it's now $5. You need to gain 100%, another $5 in order to go back to $10. So be very careful, because these kinds of steep losses may actually never go back to previous levels. It really depends on how the company is gonna do, and if you actually bought here for no real reason because the company was actually losing money hand over fist, really, I mean, this would be a massive mistake, because there was nothing to hold on to. I mean, there was no cash, there was no growth in terms of free cash flow. I mean, it would be very speculative. And so even right now, after the company has lost 70% of its value, really, its market value, I wouldn't enter the company. I wouldn't buy Draftkings here. I think it's extremely dangerous, actually. I think it could go way lower. And you have to be super careful about getting into these kinds of investments here. Maybe the company can reverse course and at some point fix its losses and go back to profitability. But right now, things are looking very sketchy for DraftKings, and there's no real point in making any discounted free cash flow model, because the company is not projected to be making money anytime soon. So it's all speculation, and hopefully, maybe the company will be able to do better in the future, I suppose. So let me know. Are you a holder of DraftKings? DraftKings? Are you thinking of potentially adding into your portfolio? And please like the video and subscribe. That helps a lot, really helps a lot. And if you did enjoy this one, take a look at this video that I made a little bit earlier, and it's about a company that's probably going to the moon. Who knows? It's called Maxar. And take a look at this one. It's a company that you may never have heard of before, and it's a very interesting one to at least be knowledgeable of. I mean, know of its existence and how it's doing financially. And thanks for watching this one. I'll see you in the next one. Bye bye.